Alright, so this is exciting because ever since the Federal Reserve started to increase our interest rates, banks have also started to raise rates on their HESAs, the high yield savings accounts. So the question is, which one of them is the best? A lot of times banks have limitations, hidden fees, and surprises. So in today's video, I put together a list of my top 5 favorite and highest yielding savings accounts. But before I show you what they are, just a quick disclaimer, I am not being paid or sponsored to talk about any of these apps. This is 100% my unbiased opinion. So let's not waste any time and kick it off with the first on this list, which also happens to be the highest yielding savings account in the whole industry that is setting the benchmark right now, and that is Robinhood's cash sweep account. Now, before you leave a comment that says, Andrei's just promoting Robinhood, please watch this video all the way through because I'll share with you some of the major drawbacks of this account that no one else is talking about. It's gonna be good. But for now, this account is paying a massive 3.75% APY, but there's a catch. The catch is that in order to get that rate, you have to be a subscriber of Robinhood Gold, which costs $5 a month or $60 a year. But that's not the whole truth, because in order to keep $60 in income, you also have to factor in your marginal tax rate of how much money you actually have to make in order to keep $60. Plus, you have to take into consideration the opportunity cost, which is $1,600. That's how much money you need to have inside of Robinhood just to break even with Robinhood Gold to pay for that $5 a month. So if you don't have at least $1,600, then this account might not be for you. Which begs the question, how does this compare against some of the other options that are free? That's what I'm gonna show you in today's video. So if you're someone who keeps their money at a bank with an old savings account that has not upgraded their rate, it's time to upgrade your money. So if that sounds good, let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the high yields. The finance equivalent of gains, bro. Now, if you're someone who does not want to put their money in the stock market right now because you think it's too risky, then this is a really good option to have. And if you missed my video on how to buy the safest investment you'll ever make in a recession where I covered how to buy I-bonds, this is the next best thing. So let me explain Robinhood's offer first, and I want you to really understand this one because I'm going to compare all of the other accounts against the highest one. And that's really the best thing about Robinhood's cash sweep is that it is paying 23 times the national average at 3.75%. There's literally nothing higher that exists in the high yield savings account space. Now, your money is compounded daily, which means it generates interest every single day and it is paid to us monthly. They take the money that is uninvested inside of the Robinhood app, which is this buying power right here, and automatically, without you doing anything, sweeps it into one of their 6 partner banks, which you can see here. Now, if you don't have Robinhood Gold, these banks will pay 1.5% APY, but if you do, they'll pay 3.75%. But the question is, how reliable is this 3.75% knowing that Robinhood's been through a couple of scandals? Turns out that Robinhood is insuring us with up to $1.5 million in pass-through FDIC insurance because they're using their partner banks. What that means is, in case of an institutional failure, our cash is protected and insured for up to $250,000. But because they're using 6 different partner banks is how they're able to claim $1.5 million. Just remember though that FDIC insurance does not protect us against investment losses. So if we buy a stonk that goes to zero, FDIC insurance will not cover that. But now let's talk about the downsides because they're actually a lot worse than you think. All right, so I'm nerding out over this. This is the coolest part of the video. Big credit to Reddit for coming up with this graphing equation. Here is the coolest way to visualize how much money you need at another savings account to beat Robinhood's Gold. I know I said you need $1,600 to pay for Robinhood's Gold at 3.75% because that's $60 a year, exactly their fee. But that is not the truth. It's much more complicated because you also have to take into account your marginal tax rate. Here's what that means. In order to keep $60 in income, you actually have to make $80, assuming you're in the 25% marginal tax rate, which a lot of people are, which means out of that $80, you have to pay $20 to the IRS just so you can keep the 60 to pay for Robinhood. So the real fee is not 60 a year, it's actually closer to $80 a year. But you also have to take into account the equation, the opportunity cost of having this money invested somewhere else generating interest without those tax implications and fees. So let's use this neat little trick to compare how Robinhood Gold stacks up against the first competitor, which is free, and that's Ally Bank. Ally Bank is a very popular option for a lot of savers because right now they're paying 2.5% APY, and the upside is that it's completely free, there are no monthly fees, and no account minimums to get started. Now, this is where it gets cool, because using an app called Desmos from the App Store, it's a graphing calculator app, it's completely free, you can download this right now and follow along or just watch me do it. We're gonna create two simple equations. The first one is gonna represent Ally Bank, and because they're paying 2.5% APY, all I'm gonna do is convert it to 0.025. Just move the decimal point over to the left twice, and that's how I got that. And then we're gonna add a variable at the end of that, which we'll call X. Super simple. The second equation we're gonna use to represent Robinhood. Here's how that looks like. Since Robinhood is paying 3.75%, moving the decimal over 2 to the left gives us 0.0375x. We'll use the same variable, but because Robinhood has fees, we're gonna have to subtract minus 80, not 60, even though 60 is $5 a month. Remember, we have to take into consideration the tax calculations, which is the real fee is closer to 80. That's why 0.0375x minus 80. That gives me two beautiful lines along with 3 dots. Now look how cool this is. This middle dot shows us the true break-even point after taxes and fees. So it's not actually $1,600, it is $2,133.33. That's how much money you need in uninvested cash just to break even and get back to zero at the end of the year. Now, in order to out-earn Ally's 2.5%, you need to look at the next dot because it is at that point, after taxes and fees, is where it makes more sense to go with Robinhood. And that last dot shows us $6,400. That is how much money you need to have in uninvested cash to out-earn Ally's free 2.5%. So that's how much money you need to make it worthwhile, and if you have less than $6,400, then it makes more sense to go with Ally's free option. The only real couple of downsides for Ally Bank is that their FDIC insurance limit, like every other bank, is up to $250,000, whereas Robinhood's option is up to $1.5 million. But that's because Robinhood is using 6 different partner banks, whereas Ally is just using themselves. Then again, if you're going with Ally Bank because you don't have $6,400 for Robinhood, chances are you're probably not too worried about breaking $250K limits from Ally Bank. I just figured that out. But anyway, if you want access to a physical branch, the only downside is they don't have one, but they do have ATM access for cash if you need. So Ally Bank is a great option. The next option I really like is SoFi because right now they're paying 3% APY and they're also free. Now let's bust out the handy dandy calculator and compare with Robinhood because this is gonna blow your mind. What you're gonna realize is the closer we get to Robinhood's APY, the more money you'll need inside of Robinhood to justify having it. So check this out. Let's convert the 3% from SoFi into an equation. Super easy, 0.03x. From this point on, we don't have to change the second equation because it stays the same. That's Robinhood. You can see the same two lines that are forming right here, and the middle dot doesn't change. The break-even point will stay the same. But the second option, you'll realize that in order to out-earn SoFi's free 3% after paying Robinhood's taxes and fees, that number turns out to be $10,666.67. That's how much money you need in uninvested cash inside of Robinhood to make it worth your while. Now, if you have that kind of money, then go for it, but otherwise, SoFi makes more sense. By the way, both SoFi and Ally get compared a lot because they're very close, so a lot of people like to have Ally as their savings account and SoFi for their checking account. But if you don't want to use either one of these because you prefer a more traditional banking experience, then my third personal favorite is Capital One's high yield savings account because it is also paying 3% APY. Now, Capital One and SoFi both use what is called monthly compounding, which means at the end of the month, they look at your account balance and then they add the interest into that. But Robinhood and Ally actually have an advantage here because their compounding is daily, which means every single day they add just a little bit of interest, which means your money has a little bit more time to grow. So if you're comparing two APYs that are the same, take a look at the frequency because daily is the best. But at the end of the day, it's still gonna make just a very small difference. Next up is another personal favorite of mine, which of course is Wealthfront, and right now they're paying a huge 3.3%. So how does that compare against Robinhood? Let's compare by converting 3.3% to 0.033x, and we can see that it would take $17,777.78. So if you have less than that inside of Robinhood, it makes more sense to go with Wealthfront. Now, I know it sounds like I've been making fun of Robinhood this whole time, but I'm not. I think they have their own advantages too. If you're not sure which one you want to pick, here's how I think about all this. If you have at least $5,000 sitting inside of a brokerage app that is just uninvested and it's not being productive, that's a serious amount of cash, and it might make more sense to go with a traditional banking experience with a savings account, a checking account, a physical branch to go to, so you might take less of an APY and go with something like Capital One. Now, if you don't care for the traditional banking experience, you don't need a physical branch, or you don't need to order checks and you're on the younger side, SoFi might make more sense. So which one of these takes the top spot for the best high-yield savings account? That really depends on what you want to get out of it. Chances are, if you're watching this video sometime in the near future, these numbers will have probably changed because interest rates are constantly going up and these companies are always competing with each other for the top spot. So if that happens to be the case sometime in the near future, here is a checklist of things to pay attention to when you deposit your money. And number one, make sure that the company you're putting your money into is FDIC compliant. That means that it is insuring your money up to $250,000. That is mostly a given if it's a reputable bank, but sometimes you can come across a fly-by-night company, maybe a crypto company, paying you 10% APY and promising you a huge return. And if that sounds too good to be true, then it probably is. So that's the first thing to pay attention to. Another thing to pay attention to is a limitation on how much you can earn. Because a lot of times these companies will advertise with a really big number just to reel people in, and they'll say something like earn 10% APY. And you'll be like, yes. And at the bottom of the page, in tiny, tiny letters, it'll say the fine print on your first dollar. The rest will be earned at 0.00001%. So just make sure you know what these limits are, because technically, yeah, that's true. You do earn 10% on your first dollar. Another thing to pay attention to are any monthly and yearly fees and account minimums, because you don't want your account to fall below a certain threshold and get hit with those annoying fees, because that will destroy your overall returns. Now, when it comes to interest rates, just remember that a small 0.25% or even 0.5% is not going to make much of a difference in the course of a year unless you're switching over a ton of money. Personally, I wouldn't even consider switching unless I was missing out on 1%, and even then I would have to think about it, because I'd rather stick with something that I know and that I'm comfortable with using, but that's a personal choice you'll have to make. So if you're ever not sure, make sure to use those handy dandy graphing equations we've made, because that's going to show you the real data, and make sure that you subtract the fees and include those marginal tax rates to get the full picture. I just want to let you know that we can't really compare bonds with high yield savings accounts, because bonds are not as liquid, meaning we can't just sell our bonds, convert it to cash, and then right away move that cash to a bank account, because you have to wait. Even one of the shortest term bonds, which is a 1-month bond that's right now paying 3.73%, even though it's higher and it's better, it's technically not better, because you have to wait 1 whole month before you get your initial investment back out. Not everyone's gonna have the time to wait, because they have bills to pay. If you don't care for any of these apps and you have a ton of money laying around collecting dust, then it might make sense to put a lot of it into Robinhood and get the highest yield possible. But at that point in time, it might make even more sense to just put it all into I-bonds or treasury bonds ranging between 6 to 12 month maturities, and you'll get the highest rates possible if you know you don't need the money anyway, or you can just diversify and have an account everywhere, and in case one of these institutions collapses, you know you'll be protected and FDIC insured, and having more of these accounts means more diversification. So with that said, I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab up to $250 worth of free Bitcoin right here, but don't forget to move it offline onto a cold storage wallet. Links are down below on how to do that. Go grab your free stonks, links are down below, and then go track them automatically with the spreadsheet link down below in my Patreon. Love you, thank you so much for watching this video. I'll see you back here on Monday, Friday, sometimes a Wednesday. This video took me a while to put together, so share it with your friends and let me know how you like it. I'll see you soon, bye-bye.